Welcome to the Finance Podcast. The topic of this episode, Building the AI-Augmented Future of Investing by Dor Aligula, Yvonne Roduit and Simon Pellety, moderated by Daniel Fernandez.
Schönen guten Morgen miteinander. Ganz herzlichen Dank, dass ihr euch so früh in die erste Präsentation und so zahlreich dahin bewegt habt. I will move to English now, if that's okay. My name is Reto Barufol, together with my colleague Maximilian Hörwig. The two of us are responsible for client relationships in Switzerland and other parts of Europe. William Blair Investment Management is an active asset manager with strategies in US equities, international and emerging market equities. Emerging market equities we do since almost 30 years. And for 5 years now, we are also investing in emerging markets debt. I'm going to be very short. My colleague, Romina Graiver, is giving you some ideas, some insights into emerging market equities. She is a partner at William Blair, and she is our emerging market equities portfolio specialist. She will discuss what we see in emerging markets. Why is it timely? It seems to be timely because 2 years ago, if talking about emerging markets, we probably would have had 5 people in the room. We will talk about what is attractive, what is interesting, but also what keeps us up at night when thinking about emerging markets. What we want to do here is an expert talk. We are not pushing any products. If you're interested in products, please come by. We have a booth downstairs near the entrance, and we can talk about everything. And now I'm going out of the way. Romina, the floor is yours.
Thank you very much. Oh, you can hear me well? Yes. So, thank you also, Reto, for the introduction. So, first of all, I wanted to highlight why I'm here talking about emerging markets. As Reto said, we have been managing emerging markets for a long time, since 1996. We have a very deep expertise in this asset class. We manage over $12 billion in assets in dedicated emerging market strategies, and more when you add allocation in other developed markets in global strategies. So we have a depth of strategies around all caps, small caps, more concentrated strategy, broad strategies, China dedicated strategies. So we are experts in the field. Actually, we are a global team, but 50% of our investment universe is made of emerging markets companies. So we really focus big time and big efforts in this asset class. And we have a very broad team, over 60 people, 11 PMs, of which half of them are dedicated to emerging markets. And then analysts, fundamental sector analysts, covering every sector from every perspective, small cap, large caps. And again, 50% of these, or 27 plus analysts are focusing on emerging markets companies. So again, this is just establishing why we are here talking about this asset class. Now, let's drill into the actual topic about emerging markets outlook. And we'll start with a little bit of backward looking and just looking at facts about performance. I think it's a good way to start. If we look at starting from 2024 and we decompose and look at what has performed well across the world, we can see that 2024, it's been 23% has been the US exceptionalism that has been driving markets in 2024. But when you look at emerging markets, and this is China, India, different key emerging markets, you will see that China did over 18% in 2024. Arguably, most of that was achieved in a very short period of time, in a few weeks when they announced the stimulus and then the market rally, but that's where it ended. And then we can see big differences between Korea was very weak, some company specific around Samsung also driving that. And but Taiwan was very, very strong. And Latin America was also some of the weakest markets. All of that correlates quite well with the sectors, right? Taiwan technology was the biggest sector and strongest performing sector. Now, when you look at stylistic drivers as well, so what worked from a style perspective in the world, in emerging markets, its quality was very strong, factor performance, momentum, earnings trends, companies with good earnings trends and quality characteristics outperformed. Valuation, cheap stocks did not particularly outperform, so it wasn't about valuation. It was last year was about companies delivering on the earnings sides and on quality characteristics. Now, fast forward 2025, and we only have until February, but have the data for these for the entire quarter, and is showing quite a differentiated picture, right? First of all, Europe is leading. Actually, the US it's pretty much lagging, and it's lagging emerging markets as we speak. At the end of the quarter, emerging markets has been, for a first time in a long time, a quarter with a significant advance versus the US. And also what we have seen is some sharp rotations. In particular, you can see India was a very strong market last year, even more so if you look at the small cap side of India. And it very significantly corrected at the beginning of the year in this year so far. We have seen some rotation in Brazil, in Mexico, so in LATAM in general. So quite interesting shifts in performance drivers, and particularly also tech being quite weak also this year has been even weaker if you look at the end of the quarter. So that rotation is very visible also on the stylistic drivers. When you look at what worked in emerging markets this quarter, it's been all about valuation. And you wouldn't be surprised, I guess, because it's quite a global phenomenon. We have seen that valuation shift as well in developed markets outside of the US, the most expensive stocks really correcting very sharply, and European banks or European cheaper stocks in Europe have rallied quite significantly. So same dynamics in emerging markets where valuation has been a big driver. So a lot happening in the background, and a lot of different themes that are driving emerging markets. I'm sure you can't read the details in here, but we're trying to map key drivers in the market, the key themes that we're seeing. Of course, the US is important for the world in general, and in emerging markets in particular. Obviously, we have a new administration that is keeping us all very busy and very tired as well. More global trade and trade war uncertainty. We're having more news coming up this afternoon, so we'll see, and we can talk about that. But in general, and we are going to focus this presentation primarily on China and India. First, because we would need a lot more time to cover every market, but also because they are really important in terms of driving overall emerging markets performance. They make a big part of the benchmark, both together, almost 50% of the benchmark, and they are very different in many ways in their nature. So we're going to drill into what is driving, what are the drivers in China. We're seeing overall, just as a headline, improvements there, but we need to differentiate the structural or more structural trends versus more cyclical or near-term trends. And we are seeing some rotation in terms of near-term trends having more favorable for China. Talking about that valuation, that shift in the market, and other drivers that are helping that. And then India, we're seeing also some more cyclical softness, but at the same time, the structural and the more longer-term attractiveness remains very, very, very high. But again, just what we wanted to show is with this is that there is a lot more than China and India, and there are other markets we are covering, we're actively investing in and uncovering. Sometimes it's smaller positions. We have had smaller positions in Argentina, for instance, but it's a very attractive and new opportunity that has been unfolding. We have seen some improvements in Brazil, South Africa, Saudi Arabia is also a market where many investors are still not investing in, or they are just investing in the very large energy and banks companies, but we are able to go much deeper because of our expertise in small caps and so on, deeper into that opportunity set. Obviously, Eastern Europe is also an area that we're seeing more opportunities unfolding, and we are we're starting to increase, have started to increase our allocations there. So, just as an overview of emerging markets all together, and before we deep dive into China and India, just basics around what is the case for emerging markets. Valuations remains very attractive, and we've seen these for a long time. I mean, there is a discount. This is the relative price earnings of emerging markets versus developed markets. It has been coming down. It's really at historical lows now. And obviously, when you look at the disaggregation of different regions, emerging market stands here, is the cheapest compared to any other region. It is within the range, slightly above the historical range, but we could argue that the quality of emerging markets companies and the composition has improved as well. There is more tech in emerging markets than there was in the historical context. But it's true that the developed markets price earnings is very heavily impacted by the US. Valuations, we're all familiar with this. It's been coming down, but still very much on the high-end level. So valuations arguably is attractive. Has historically not been a sufficient condition for emerging markets to outperform, but it is a very important factor, especially when we're seeing this rotation towards valuation matters more. So the second point is growth. So you have valuation and you have growth. So what we are looking at here is predictive expected and forecast GDP growth, real growth for different markets, emerging mostly here on the higher end, developed or most developed markets are towards the weaker end. It's true that the second derivative matters. So we're seeing some markets or some economies where growth is slightly deceleration. We've seen that in India, where we're seeing growth is normalizing from very excessive, very high levels, still the fastest growing economy in the world with a very large scale. But at the margin, we're seeing some softening trends, whereas other markets, other economies like Germany, unexistent growth, but we're seeing the potential and the opportunity for an increase there. Again, all of this is at the margin making an impact into where growth and how things are moving. Earnings, when you see companies aggregate earnings growth, the yellow being the US remains solid. Emerging markets in orange above developed markets ex-US. And we're seeing also earnings momentum have been weakening in the US and somehow accelerating in Europe and in emerging markets. So again, all that second derivative of where revisions are getting stronger and better is outside of the US. And the last point about the drivers of growth, or at least of performance, is we know the dollar has a very high correlation with emerging markets performance. It's been historically proven, and there is very few occasions where this has not been, a weakening in the dollar has not followed by a outperformance of emerging markets. So we're seeing at the moment, after a very strong streak of the US dollar strengthening, we're seeing weakness there, and we expect that this may continue given the direction of travel in the U.S. economy and the concerns about weaker / recessionary economy going forward. Now, if we start now drilling into China more particularly, we talk about things going better at the margin or in a kind of more near-term outlook. There is a number of positives that have been developing over the past quarters, I would say. But the negatives, they seem to be smaller points, but they are very important. So there are less number of bullet points in the side, but they are very important in terms of the continued weakness in the consumer sentiment, in the property market. These are very, very heavily impacting economic growth and sentiment in the market and so on. We're seeing that confidence has not really materialized in an improvement, despite the fact that we have seen real efforts from the government, and we are going to highlight some of those to stimulate the economy, to support policies to support the property market, to support consumption, trading programs, to support the capital markets, to support innovation. So there is a very decisive move around supporting the economy, but this has not necessarily yet translated in better confidence, which is really necessary to hopefully unlock the very large and growing excess savings that have been built in the economy and get that hopefully flowing into activity and into the capital markets. So improving in sentiment, we have seen some rebound, some deep-seek moment in January has been triggering a rally in China and China internet names, and this is also having some impact on sentiment. And we think some of the government also initiatives on that would be continue to be supportive. So again, not to forget the weaknesses and the more structural or fundamental weakness. The property market continues to go down. Maybe the margin or the rate of decline has stabilized, but we are not out of the woods. This is a very complex and deep problem that is going to be, seems to be tackled in a measured way and hasn't been a massive bazooka stimulus that we may have expected at some point, but a very clear steps and announcements, especially since September last year, that are signaling that the government is going to continue to support the property market and the economy. Again, the correlation between property and GDP growth is huge. So as the property goes down, we are seeing other relays. Exports has been one, but consumer is not really taking over. So we need, as property continues to go down, and there is some risk on the export side, to have consumption or other relays to continue to support that growth. So also has a big impact on unemployment, which remains an area of concern. Now, the government, I mentioned, has been proactive on policy, on monetary policy, on some fiscal policy, measured. So the magnitudes have been somehow disappointing versus some of the stimulus we have seen in other countries in the whatever it takes moment or the Fed post-COVID. But we are seeing monetary policy reductions, and at the same time it's rate cuts. And at the same time, this is quite interesting because what we're seeing with total social financing is that the measure, the impact and the actual leverage of the financing into the economy, actually it's been declining, partly because the impact of the total social finance and the leverage and the liquidity injection into the system have been coming down and down. You get less returns, basically less impact for every unit of credit that is injected into the market. That's something that has been, that's because it's less effective, we're seeing less and less declining injections, declining credit growth into the economy. So that said, wanted to highlight some of these measures. I mean, this is just an extract of some of the significant measures that have been announced. Again, it's a long list, much longer than that, and many more details. But since September to March, with the more recent one has been State Council saying special action plan to boost consumption, trading programs on electronics, on cars. I mean, we have seen all kind of subsidies. We have seen also quite important President Xi meeting with Jack Ma and the entrepreneurs, the driving force of innovation. After that's an 180 degrees turn from where we were a few years ago, where there was a crackdown on innovation, on tech, and internet names, and now they are welcome back to support. So that private sector support has been really very welcome. But obviously, we are, at least as as investors, there a bit scarred from the previous episodes and these shifts in mood and in policy. So that said, you can't really ignore. President Xi and the Chinese government, because when they want to stimulate the economy, and they've done it in the past, you've seen these are the rallies that the Chinese equity markets have experienced. We're talking about 3-digit rallies and many times for, in periods of stimulus that were pronounced and were very decisive. So we as investors need to pay attention to this, understand what is real and what could actually provide this performance opportunity for our investors. So at the same time, this is what we're dealing with, and not supposed to read every single little dot here. This is our internal systems and things that we need to monitor on China, beyond looking at companies and expectations and valuation. We need to understand a lot of the regulatory, internal, domestic regulatory risk and the external risks. So we have seen in the 2021 episode of Common Prosperity that a number of industries became uninvestable, private education, healthcare, where we saw price cuts for 90% price cuts in drugs, and certain drugs. We saw all kind of actions against certain fintech companies and so on. So we need to monitor what's going on. Again, when we look at the investable China, what is investable in China, until very recently, we had almost 40% of the MSCI China that was impacted in some way by regulatory measures from Common Prosperity, and in our view, that would make them very risky or uninvestable. And then you have other areas that are impacted by the trade wars with the US or export tariffs and so on. So we really need to understand and navigate what are the risks that we're having, both domestic and internationally from Western governments. And I think this is really important going forward. We're seeing the tariffs are going to continue to increase. So how you position your portfolio, where you invest, how much exposure you have to these risks and to opportunities to generate alpha is going to be even more important going forward. Now, key themes in China that we're finding those opportunities. We're seeing China is the global share of auto car production, not CAP. China is becoming really almost 40% of auto production. We've seen innovation with BYD, recent announcement of supercharger and additional 400 kilometers in 5 minutes charger. So this is really key drivers of innovation. We've seen that also with DeepSeek. And all what opens up in terms of implementation of AI for different companies, especially on the e-commerce and internet platforms, and also things like Xiaomi becoming a key leader in smartphone. We don't feel necessarily very close to it in Europe, although it's number 3 in overall Europe. It's number 1 in India. It's becoming increasing market share, and actually it's becoming a very innovative technology company with the launch of cars and electric vehicles that are actually very high-end and proven. It's like having Apple developing cars and selling cars, and this is something that a Chinese company has really managed to do it, and is benefiting to a whole ecosystem of services around smartphones, from car integration with cars and so on. So other themes is online travel, and travel is continuing to be a theme that is attractive in China. Online advertisement opportunities still growing. And importantly, this is interesting. You're not going to be able to read it, but I'll tell you what is showing is how is the market share within China of different brands of energy drinks. It's just an example, and I think it's quite visual example of in 2018, Red Bull was 60% of the market share in China, and then quite diversified other brands, much smaller percentages. Fast forward 2023, and what is expecting to 2026 is it's a substitution of foreign brands of the Red Bull by a dominant champion, local champion, which is Rock. And that is interesting how, and still other brands are existing, but the emergence of local champions is something that we're seeing, and the substitution of foreign champions is something that we're seeing in many areas in China, and is unlocking opportunities for investors within China. So, from China to India, just going to a few elements of India, positives and negatives. So looking at the structural story of India, it's an incredible path and still growth opportunity. The demographics into growth, which is unique. China is shrinking population. India is growing population still. Favorable, very well-educated population. The healthy economic growth, and all of that is a pro-growth and most Western ally type of government. The rule of law is working. Is a very different, or almost at the opposite of China in many ways, and that is how it's positioned itself as well. So what we've seen is, and over the last years, what we have seen is earnings growth, which is that blue line, in India, relative to emerging markets, has been accelerating incredibly strongly. So, and that has also driven some multiples as well have increased. So the relative multiples, the valuation of India is high, it's expensive, we all know. But one of the reasons why that is the case and has been sustainable is because earnings has been so strong. So our point is we are seeing some at the margin, some weaknesses in India. Earnings have been so strong that the second derivative is becoming a little bit softer. It's been more difficult to continue to beat and growth at that path, especially as we're seeing the economy also is normalizing from excessive and very, very high levels of growth. But at the same time, again, we are seeing many longer-term and even medium-term support to the market, and we're going to go through that. First of all, highlighting on the structural path, again, the contribution, because India is growing at a faster rate, is compounding at a higher rate. The contribution of India to the global GDP growth is becoming more important. So basically, India matters more now, and it will continue to matter more for the rest of the world. So it's going to be a player, and it's growing in terms of importance in the global economy. Another theme is the story of the penetration and the consumer story, especially from investors like us, where we're seeing opportunities is the growth of the middle class is a continuous path, is continuing to increase with higher incomes and development also comes, and the creation of wealth also comes a different consumer pattern. So what this is showing is basically what are the categories of consumption over time, which very much align with if you're in a lower class or middle class or upper class. So it's moving from staples, so basic consumption, basic goods, to a lot more discretionary, transport, communication, travel, leisure. Those are the categories that become more important as the middle class continue to grow. You have a wall of money and of consumers that are looking for these type of products. And that's been a long story, that's progression in terms of the categories of consumption. One that is relatively newer or more recent, it's been the industrialization of India and the capex story that has been driving a lot of industrials companies in railroads and infrastructure, and as well as this program that the government has put around digitization, electrification, renewable energy, and that massive investment has been a strong driver of many industrial companies. It is continuing, some softness on capex side, but it is continuing in certain areas, in defense, for instance, in cabling companies and wires. So this is a very attractive theme. Another theme, just to give another example, is Indian financials. Very low penetration, very low mortgage penetration, and we're seeing housing prices and sales going up. So if we compare China with all these risks and kind of a bit of shrinking opportunity, because you need to be careful of this area and you need to be careful of regulatory and what part is on the crosshair also with Trump, it does seem somehow that India is a broader opportunity in terms of the consumer story, in terms of a lot of the industrials, the financials. So we have a much broader opportunity set in India. And then lastly, while valuations have been coming up very strongly, and this is the India price earnings, which has gone quite ballistic, a little bit too high versus historical standards, more than one standard deviation. It has come down now quite significantly. And most managers, emerging markets managers, are underweight emerging markets. You can see it here. So yes, long-term performance, and this is looking at Indian small caps, has compounded at a very high rate compared to this is India large cap, and then you have China. So it has compounded at higher rates, and partly is because the flows, you have a very strong ongoing domestic flows. So there you have in India, it's been established over the past years, these SIP accounts that are automated saving plans where receive flows from automated, from income, from wages that are invested into domestic market, primarily in small caps. These are the flows that are the domestic ones in light blue. Only in COVID it's been negative, but otherwise these are billions and billions of dollars going into the Indian markets, supporting that valuation. The international flows have been weaker, so foreign investors have been switching into China, going out of India more recently this year, but the domestics are there, and they are a big support a technical support for the market. So very conscious that it has gone through a deep correction in the very recent past. This year to date, you can see the performance of the large, mid, and small cap indices in India. But this, when you look at calendar years, we have seen extreme and very strong returns for a long period of time. So when you analyze the different corrections and drawdowns that we have seen in India, what you can see is that, and it's hard to see, but I will tell you the bottom line is that we are currently at the level of correction that is in line with historical average of this type of corrections and drawdowns in India. So the magnitude has now reached similar levels as other episodes on average, especially when you exclude COVID, that was very specific. And when you look at the relative performance of India versus emerging markets in a rolling 6 month, when you see these type of corrections, it has rebounded in similar levels, and talking about two-digit growth declines followed by very similar magnitudes of rebounds. So we are expecting that rebound. Actually, March is already showing initial rebound. This was still as of February. So again, long story short, and just stepping back, India versus China. China is the second economy of the world. Largest economy. We can't ignore China, and there are opportunities there. But India is creeping up. It's going up in terms of versus other economies. We're seeing, again, the population driver that we're seeing. India is still expected to contribute to population growth 21%, while China is going to continue to shrink, and opportunities also in terms of some areas where India actually is more advanced than China in several perspectives. So just to close on China and India, I'm not going to go through other markets. I mentioned Argentina, Saudi Arabia. These are things that we are looking at. Tech hardware, many opportunities there. But last but not least, I would like to say that emerging markets as a whole, when you look at where is the sustainable value creation, where are the companies with sustainable value creation, meaning higher returns on capital, and you look at the top decile of companies with higher returns on capital, and then you see where are those companies from. When you go at 2002, mostly we're in the US, and then also Europe, UK, developed markets. Only 15% were from Latin America on green. Less than 15% were in emerging markets. Fast forward 2024, and you can see that that emerging markets represent over 30%, 40%, let me see. Almost 40% of where are the highest companies with highest returns on capital. You can see how China has increased, India has increased, emerging Asia has increased their contribution to the best companies in terms of returns on capital. So that is something that is not fully reflected on the fact that emerging markets still represent roughly 10% of the index globally, but the best companies in terms of returns on capital, returns on invested capital is very much higher than that would represent. So again, wanted to show and finish with our track record over the long term. This is our gross and net returns versus the benchmark. It's been a ride, but again, we've been managing emerging markets since 1996, navigating very different market environments and difficult ones. We are in a difficult one at the moment, not just in emerging markets, but in the world. But we're very confident in our ability to continue to deliver on performance. Thank you very much.
Fantastic.
Yes.
Thank you.
Yeah, so the correlation has varied, and it's true that, for instance, China has been a lot more decorrelated. The correlation has diminished tremendously. So when you look at emerging markets as a whole, it's almost like China and then other markets. There are markets that are more dependent. They're still more like a beta to developed markets. But also, when you think about developed markets, I think the big question behind maybe is the U.S. weakness could be they are becoming in some way more independent when you look at the contribution and because even if it is just because of the impact of China in the indices versus the past. But also is where growth is going. What matters is global growth. The point is Europe will be able also to compensate that faltering demand from the US if we're going into some kind of slowdown in the US versus an acceleration in Europe? Would that be sufficient also to generate that demand that is of products and services that are coming from emerging markets? But it's a complex dynamics, but what we have seen is that there are emerging markets could continue to could do well regardless of, again, the US. Correct, and that's the point I was making about. But the weighting of Turkey to move. When you look at the emerging markets, actually, you're looking at the index, you're looking at passive, you're looking at managers. The weighting of Turkey versus the weighting of India, that's of China, and that's what I'm saying. When you think about China, India, and basically Taiwan, it's really moving the entire emerging markets. Now you can look at the drivers of each markets, and then you have the opportunities also in LATAM and other areas that should not be disregarded as well, because while smaller impact, they can have a marginal bigger impact if they perform better. It's a great question, because actually we are quite unique in that respect, because not only many managers are not invested in well, this was last year, but almost 60% of emerging markets managers did not have exposure to Saudi Arabia as of last year. But also, most of those that have exposure, they tend to have just Saudi Aramco or some big banks. You can see financials, materials. Healthcare. Energy is not that big because the float is still small. But it's actually. Those are, in our view, not necessarily the most attractive opportunities because of governance, because state-owned enterprises, very linked to the government or needs and so on. But we are finding a lot more attractive opportunities in consumer or consumer-related names. We say consumer-related names could be healthcare, because healthcare is private hospitals are very much linked to consumer and income of the population. So we have, especially in small caps, we have been investing in things which are leveraging also changes in the in reforms, the reforms and the social reforms that we're seeing with more female labor participation and entertainment and development of cinemas and all these things that are actually happening in Saudi is creating a lot of opportunities. One of the things is, for instance, gyms. Gym chains is something that they are promoting. Government is really promoting healthcare prevention, and there is a lot of chronic diseases among the population in Saudi. So it's really the gyms are becoming a bigger thing, and you have more sophisticated gym chains that are popping up, and they are creating really great businesses, private enterprise, privately owned, in healthcare, in again, consumer-related areas, in anything from milk companies and dairies and so on. So a lot more opportunities than it may look just from the makeup of the index. Thank you very much.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.